everyone. So today's Tuesday. What's going on in the market and what's happening and how do we take advantage of this huge thing that we have built, the stock market, right? So welcome to my channel. I am here to educate you. I'm here to explain to you what's going on. I'm here to hopefully make you some money, hopefully avoiding you losing any. That's also very important. Keep in mind at the end of the day, it's about two things. Stay with me for a second here. It's about the income, it's about the money you're going to be making right on the stock, but it's also about how to not lose any. That's two different things. It says risk, there's the price risk, right? And then you have the credit risk. And then when it comes to price risk, right, the stock going up and down like that, it's also about making sure you protect whatever you have. Right now, the market focuses so much on how much money you can make by holding NVIDIA. That is not always the case. What you want to do is you want to make sure that you take care of what you have. You take care of what you have by managing the risk, and that's a difficult part. Managing the risk is much more difficult. Why? Because you have to be able to understand risk. Anyway, so what do I always say in terms of education? The first thing that I say is you need to buy when everybody else is selling. Right now in the market, it is calm water. Nothing much is going on. They got all crazy on Monday because of what happened in Japan and because they thought that unemployment was going to be an issue. But now it's calm. They're all watching. They want to know. They want to see where's the next shoe going to drop. And the people that kind of on the fence are saying that the economy is in a recession. And if the numbers come out negative, you're going to say, I told you so. I told you it was going to happen. Oh my God, I told you it was going to be a recession. And we are in a recession now. Didn't I say that? Didn't I say that? Yeah, I know, but you have to say it today and you have to hold on to it because right now, quite frankly, as far as the economy is concerned, we are slowing down. I mean, but we're not in a recession. I mean, we have some soft number out of Home Depot, for example. You know, basically it gives you a feel for what's going on in the economy in terms of retail, but Home Depot is kind of like that. A little bit disappointing, but it's not a catastrophe. It is not a catastrophe. So the market is kind of asking what's going on. You know, where's the story with the market? That's important. Understanding a story is very key. Let me show you an example why, why the story is important. Right? If somebody tells you about Moby Dick, what's the story about Moby Dick? You're going to say, well, it's about a whale and this guy wants to kill the whale. It's nothing to do with the whale, right? Frankenstein. Well, it's about a monster. It is not about a monster. What do you mean it's not about a monster? What do you mean it's not about a whale? No, it's a much deeper story, right? The story with Frankenstein is about the story of life, of getting a child, of the parent-child relationship, right? It's not about a monster running around killing people. And the same with the white whale. Everybody has a white whale that they go after. It's a bigger picture, right? And that's why it's important to understand what the story is about, what the real story is about. In the stock market right now, what is the story? Is it that inflation is under control? PMI came out today, looks tamed. So therefore, the Fed is going to lower the rates. So that's what you want, isn't it? Well, yeah, but the story could also be about the fact that we're going to enter in a recession. So now if you're lowering rates and you have a recession, the market is going to look at it differently. It's going to say, oh my God, this is worse than I thought. The market is predicting a recession. We're in a recession, and that's why you're lowering rates, not because you're managing inflation. Do you see the difference between how the story is being told? It's a story. It is not a fact. It is not true. But at the end of the day, no one really knows what's really going on. And I keep saying that. No one understands what's going on. Nobody knows the truth. What do you mean nobody knows the truth? No, I don't know what's going on right now in the economy. Is the economy doing great? Is it not doing great? I don't know. I'm looking at data, but the data is old. I want to know what's happening now. So it doesn't really matter what's happening now. What's happening is what they think is happening. And that is how you take advantage of the market, which is another thing I keep telling my viewers, is that you need to take advantage of the market. You need to buy when everybody else is selling. You need to understand what risk is about. That is what's important. And that, unfortunately, is not the most easiest thing to do. But then again, if it was easy, everyone would be doing it. Okay? Don't forget to subscribe to this channel. Don't forget to put a like on this channel, because the more like I have, the more people get to see it and the more I get to talk to you. So it's about the story. It's about what's going on. It's about what's about to happen. It's about what people think is going on. Now, having said all that, you say, well, this is great. Fine. Well, what do I do as an investor? How do I take advantage? What do I do? Well, take a look at all the stocks that I gave you in my previous videos. I gave you a bunch of stocks, small caps, with growth, with low PE, and with not much debt. So very safe. Why do I want safe? I want safe, meaning that not too much debt, is that I have that much cash available, right, and no debt. So in case the economy does slow down and the economy does hit some of these companies, because they said, no, don't do that. Don't go for small caps. Why? Because if the economy is slowing down, what are you going to do with a small cap? They're going to get hurt. But a small cap doesn't necessarily mean small, doesn't mean minute, doesn't mean it's going to disappear, right? It just means that it's a small capitalization. People have not paid attention to this stock. So what do you need to do? You need to pay attention. So the stock that I proposed, 5 or 6 of those, I think I proposed 6 so far, they are all growing in terms of EBITDA and cash flow. They all have almost no debt, so very little amount of interest expense. So in case rates go down, in case the cash flows goes down, they're not going to hit that much, right? That's fantastic. And also the P ratio, if you believe that measure, is pretty low because it's also in the Russell 2000. Russell 2000 is at 10, 12 PE. The S&P 500 is at almost 32 PE, right? So they've been bidding up the prices forever. Yeah, I know. NVIDIA is doing great. You're going to retire in NVIDIA. Really? It's not that simple. So you want to capture that story of the small caps, right? And you want to grab it because right now they are cheap. Therefore, you buy when no one else is buying. That's the time to buy, not when they start to realize that these stocks are great. Next, the other way you do it is you say, well, let me play some of the volatility, because obviously those stories that I'm telling you, they're moving. There's stories saying this and stories saying that, and I don't know which one to believe. And, maybe this week we have nothing happening, but imagine CPI comes in on Thursday and it's high. What could bring the CPI up? You could have a war in the Middle East. Right now, we're waiting for something to explode down there. There's something going on in Russia and Ukraine, in case you haven't noticed. And now Ukraine is invading Russia. I don't know how they're going to react and what are we going to do and what's going to happen with the new president, without it, right? If that creates an issue with oil is going to bring out the value of the CPI, which is going to give you the feeling that there is inflation. And since the Fed is data dependent, they're not going to lower the rates. And now the market is going to collapse. You're going to say, well, you were supposed to lower the rates, because now you're going to keep rates high. And don't forget, we may have a recession coming in. So what are you doing? And of course, I encourage you to watch this channel, obviously, but watch the other channels. See what they're saying. See what the market is talking about, because you need to get a feel for what they're thinking, right? So if they're over there panicking, Although right now I will tell you most of the stories are basically saying, oh, everything is fine. Well, yeah, because everything is fine, right? On Monday, you didn't say that. You're saying after the fact. You say, what do you think is going on? Is it, I think we're going to be okay, the economy, blah, blah, blah. You didn't say that Monday, right? You're saying it the next day. Plus, at the end of the day, what are they going to tell you? You're going to lose your shirt, so therefore get out of the market, right? If you get out of the market, they're not going to make any money. Nobody's going to be watching. So they have a tendency of wanting you to stay in the market. That's important. Okay. So I do talk about this idea of risk, right? What do I mean by risk? Because you have two risks, right? You have the credit risk, the risk that you can't pay your debts. So that's why I pick names that are very, very small amount of debt measured by the interest expense, or the risk of the stock price moving. The uncertainty, what's driving this thing? Is it the same thing that's driving the credit risk? Are they correlated? When you listen to everyone else, it would seem to appear that they equate or they correlate the stock price movement with the earnings movement. They tend to put them together. But you should know that the most successful investor, Jim Simmons, was a mathematician. And this is where things take off and become interesting. Why? Because what you see is not what you get. What is up is down. What is down is up. What do you mean? What is up is actually down. Why? Well, because I'm on this side of the earth. If I'm on the other side, right? If I'm pointing up, I'm pointing the other direction. So it's all a matter of how you look at it. Can you measure the cost of England? Of Scotland? Not really. You can't measure it. Google it. It's very difficult to do it. And of course, overriding all this, all these people running around, people like me giving you advice, talking what they think is happening, although I tend to kind of explain things to you as opposed to tell you what's going to happen. The Fed is sitting in the middle. What is the role of the Fed? What do they do? What do they do? Well, they're supposed to manage inflation. That's their job number one. So you being in a recession is not so much a concern to them. So you need to understand the players as well. Who are the players? Who are the people talking to you? What are they deciding? You need to understand the people that are giving advice on CNBC and things like that. What do? Well, they basically tell you what they think is happening based on what they've done. If I buy SPY and I say, I think it's a great deal, and you listen to me and you buy, I say, I told you it was a great deal. Look, the price went up. Sure, the price went up because you told us to do it and we listened to you. It's very emotionally driven. Look at today. Something happened with, they replaced the CEO for Starbucks because obviously Starbucks wasn't doing that great. And the guy Chipotle moved over to Starbucks and the price went up 20%. Why did he go up by 20%? Well, because they basically say that he's going to do a better job at what? Making more money for the company. So there is a link between how much money you're making versus the amount of the price, the way the price moved, correct? So that's great. But that's emotionally, 20% just based on some future expectation as in the future, whenever that is, he's going to do best. He's going to do better. Is it that? Or is it that we were surprised by the announcement and we were positively surprised, so we tend to overreact? The same way that on Monday, when we came to work on Monday, everybody was doing great. And then this thing with Japan hit that they pulled back their liquidity and the market tanked. And then they say, oh my God, remember on Friday also we had this horrible news in employment? Oh my God, we are. Do you surprise? Right, the market hates surprises, and it definitely hates surprises when it comes to liquidity, because please understand one thing: this whole show, everything has to do with liquidity. If there is no liquidity, there is nothing. It's like blood. And liquidity is confidence, right? When you put money in the bank, you're confident that you could take your money anytime you want, even though your money is not there anymore. But you believe that it's in there. And you have confidence in the market. When you look at a piece of paper, mark a dollar, you know that it's worth something. And that's the reason why, after the 2008 crisis, we came up with the Bitcoin. Because there was only a fine amount, and they realized, listen, the Fed is probably not the best person to tell, or the best institution for us. Why? Because they missed the boat. They didn't realize what was going on. So let's create a tool that has a finite amount of item. I think there's only a few shares left of Bitcoin to be found, to be mined, right? That's what they do every day. They want to mine it. It's worth it because they're worth, I don't know, $86,000 each. So we are mining the Bitcoins right now to try to find out, but there's only a finite amount. The same way there's a finite amount of gold. What do you think goes up in value in this uncertain time? Because there's only a certain amount. Dollar is not so good because you could print the thing. It's only a piece of paper, backed by the full faith of the US government, but still it's a piece of paper, right? So all these things are coming into play, and you need to understand. So what should be your next move in the stock market? What should you do next? Well, what you should do is you need to make sure that somehow you are protecting your portfolio. Why? Do you think something is going to happen? No, that's not the point. The point is you have house insurance. You have house insurance, right? When you ride a bike, you have a helmet, right? Okay. You have insurance in your car, you have a seatbelt, right? Something's going to happen? No, we're not predicting. We're just saying you need to have it just in case, because we cannot predict these things. You need to make sure you're protecting your portfolio at all time. And how do you protect the portfolio? Well, you could use options. Take a look at my portfolio. I have options listed there. Take a look at different things. It's important. It's important to understand what's happening. It's important to know where you are. And it's important to know what your goal is. Because ultimately, as we've seen, stock prices go up all the time. What kills you is the in-between. Right now, I would say that if I look forward, I am concerned. I am concerned about what we do not hear. I am concerned of what I do not know. And like Socrates, I know that I don't know everything. I know that I don't know. I know that I'm like a child and I really understand what's going on. I need help. And that's what's about. And that is why the stock market is truly a representation of the wonders of it all. Don't forget, security analysis, financial analysis, these are just an art. It's not a science. It's a quasi-science. It's something that looks like science, but it's not, because we don't really know what's driving it. So there's a little bit of a mystery. Today, like I say, Starbucks went at 20%. Why not 15%? Why did you go up? The guy hasn't come to work yet. Yeah, but he did some great work over at Chipotle, so he's going to do some great work over at... How do you know? Somebody made money today. I guess they made money if they knew, A, that he was going to join, B, that he knew how the market was going to react. Is that luck? 20% in one day, that's a lot of money. And by just him showing, you see the danger and yet the excitement of the market, right? Because you don't know what people are going to do. Are they going to come in? They're not going to come in. Are they going to do it this way or that way? We don't know. And that is what you need to be aware of. So remember, for the upcoming week, pay attention to the CPI and prepare yourself for some big surprises, because While we're not talking about this next event, while we're not talking about the debt, we owe 35 trillion. I keep telling that, and this is going to be a problem at some point. And it becomes a problem when they don't want to lend you any more money. Keep that in mind and think about it.